right, now that we reached over 300 participants, we can begin. But first, let me start with a short video to help you to get to know us in under 1 minute. Hope you can hear it.
Same financials, same short-term risk, but their climate risk profiles tell a totally different story. We quantify the financial materiality of climate risk. Short-term financials do not equal long-term resilience. For long-term investors, climate risk matters. In 2025, the ratings of more than 6,000 infrastructure assets are freely accessible. In 2026, more than 5,000 leading listed companies will be rated. Scientific climate ratings. We turn climate science into financial insight. Now you know.
So now that you know who we are, let me give the floor to our speakers.
Hello everyone and welcome to our very first webinar. We just launched Scientific Climate Ratings less than a month ago and we are thrilled to have you join us on this journey. I am Rémy Estran-Fraioli, the CEO of Scientific Climate Ratings, and I will be joined by Maria Peykova, my colleague and sales director. Here is what we have planned for today's session. I will begin with a brief introduction on our ratings and share a few facts and figures about what we do, followed by a high-level overview of our two complementary ratings. The PCER, or Potential Climate Exposure Ratings, will then be presented by Maria, and I will return afterward to present the ECRR, or Effective Climate Risk Ratings. By the end of this session, you will understand how they work, how they differ, and why they complement each other. So finally, Maria will close the session and open the floor for the Q&A. We are truly excited to have you with us, and with that, let's start the presentation. So Natalia, I think you can move to the next slide, please. And the next one again. Yes, thank you. So first of all, when we say a new standard in climate risk ratings, I think we want to make it very clear from the outset that our focus is on the financial materiality of climate risk. This doesn't mean we consider impact materiality as unimportant. On the contrary, it plays a critical role in shaping long-term outcome, but it's a different area of focus. Our impact materiality, as you know, looks at how companies' activities affect people and the planet, while financial materiality refers to how climate risk affect the value of a company. Our expertise lies in translating climate risk from a vague, non-financial concept into concrete monetary terms. By doing so, we aim to make an impact, shifting capital and investment from the present to a more resilient future. That said, there are often strong links between the two materialities. For example, the most polluting assets in terms of carbon emissions are also often the most exposed to transition risks, such as carbon pricing or shift in consumer demand. So even though our focus is on the financial consequences, we are often measuring phenomena that matters deeply from an impact perspective too. With this approach in mind, let's move on to the next slide on the rating coverage, please. Yes, thank you, Natalia. So this slide shows the geographic footprint of our infrastructure coverage, more than 6,000 assets across 25 different countries, spanning sectors like energy, transport, social infrastructure, data center, and much more, like every kind of infrastructure, basically. It already represents over 3/4 of the privately investable infrastructure universe. By privately investable, we mean assets that are accessible to institutional investors, not owned and operated purely by the public sector. Because of this focus, our coverage is, as you can see on the map, strongest in North America, South America, Europe, and Australia, where infrastructures are typically open to private investments. In contrast, coverage is more limited in regions like China or Africa, where large-scale assets remain predominantly state-owned. Focusing on privately investable infrastructure has been a strategic choice for the starting point. But that said, if you're looking to assess the climate risk of a publicly owned asset or a different kind of infrastructure, please feel free to reach out and we'll explore how we can work together. We are, by the way, already actively engaging with public authorities on this front, and our coverage is definitely set to expand further. Finally, we are also planning to extend our methodology to the listed equity segment in 2026, covering over 5,000 listed equities next year, so stay tuned. And in the meantime, Natalia, let's take a look at the next slide to compare our two core ratings, the potential climate exposure ratings on the left and the effective climate risk ratings on the right. The PCER is designed to identify and quantify the exposure of assets to various climate risks, helping basically stakeholders prioritize which asset needs the most attention. It relies on a relatively limited but very precise set of data, such as asset type and location, which help us understand physical exposure to climate hazard, and the asset carbon intensity on both scope 1 and 2 for the direct emissions, as well as upstream and downstream scope 3 emission to gauge transition risk on the entire value chain. This streamlined approach allows us to provide the market with a global benchmark of more than 6,000 infrastructures, all assessed with the same transparent methodology. On the other hand, the ECRR is much more detailed. It goes a step further by translating that exposure into financial impact on net asset value over time. It involves valuing the infrastructure itself, requiring extensive financial data like financial statement, debt structure, cash flow models. We integrate climate risk data into these cash flow models, which means the process is much more time intensive and often requires direct engagement with the company's financial team, much like in a credit rating actually. So as a result, the coverage is more limited and customized. It's, I think, important to note that two projects with the same potential climate exposure ratings can have very different effective climate risk ratings. This is because even if two projects have the same level of exposure, their financial resilience can vary greatly. Factors like cash flow structure, strength of the balance sheet, debt level, future adaptation plans all play a critical role. And while one project might be financially robust enough to weather the storm, literally, another might be impacted more severely. So this is exactly what the ECRR captures, how climate exposure translates into financial impacts. This distinction between PCER and ECRR is crucial to understand, and together this rating complement each other, offering a comprehensive view of both exposures with PCER and their financial implication with ECRR. And with that, I'll hand things over to Maria, who will go into more detail about the PCER.
Hello, everyone. I'm very happy to be part of this webinar today. As Rémy said, my name is Maria Peykova. I'm Sales Director at Scientific Climate Ratings, and I'll try to unpack the founding stones of the potential climate exposure rating methodology with you over the next slide. So if we move to the next slide, thank you very much. That's perfect, thank you. So that slide is quite packed, but bear with me and follow my lead and we'll unpack together the various boxes here. So as a reminder, and you have heard that, this rating provides integrated assessment of both physical and transition climate risks, and that evaluated across two time horizons, 2035 and 2050. The scores are grounded in what we call the continuity scenario, which is the most probable scenario based on on current policies and on current trends. So if we now start looking at the various stepping stones, we'll start on the left-hand side of that chart under data and models, and we'll first look at the upper part of the slide. So for the physical exposure, what we use is very precise satellite data on asset level location, as well as damage functions. I'll elaborate more on that approach over the next slides. Then it's very important to understand that we use adjustments, and those are asset specific. And for physical hazards, we will look at asset specific resilience strategies. That I will elaborate on as well over the next slides. Now, if we get to the middle of the chart where we explain how we score expected hazard damages, we look at 4 physical hazards. We score floods, storm, heat, and wildfire. You may wonder why those 4 hazards. Well, according to the United Nations Office for Disaster Risk Reduction, the flood risk and the storm risk account for respectively 44 and 28% of all climate events that are that infrastructure assets are exposed to. So with this, if we add the 3rd hazard, which is heat, which accounts for 6%, we are already at 80% of all the climate hazards that an infrastructure asset is exposed to. And we also cover wildfire. And let's remind also that for these 4 hazards, we have damage functions, which I will elaborate on, which is also the reason why we chose those 4. Now, with these 4 hazards, we will measure annualized total asset loss in percentage for each of the hazards. We will then sum these hazards and we'll produce a rescaled average of all these across the years up to the chosen horizon, let's say 2035. And that is what gives us, and I'm still in the upper part of the chart, this is what gives us the physical exposure score. Now that we have unpacked the physical exposure score, let's move down to the transition exposure. For the transition exposure, we use as the key inputs on the left-hand side, again, the scope 1 and 2 intensities and the scope 3 intensities, both upstream and downstream. We also use asset-specific decarbonization strategies to further refine the various components that are part of our ratings. And we calculate what we call policy and technology exposure score and market preferences exposure score. So let's try to understand that. For policy and technology exposure score, we use what we call the rescaled average of scope 1 and 2 carbon cost indicator across all the various years up to the chosen horizon. The carbon cost indicator is the carbon tax multiplied by the scope 1 and 2 intensities. And that is a proxy of policy actions aimed at reducing carbon emissions. We'll elaborate on that a little bit more over the next slides. The market preference exposure score, on the other side, is calculated similarly, but it's based on, again, the rescaled carbon cost indicator for scope 3 emissions, which is the carbon tax multiplied by the scope 3 emissions. And that is a proxy for market preferences, meaning that we will reflect regulatory or self-inflicted changes in market preferences that impact the cost of carbon throughout the entire value chain. Now, we use these 2, policy and technology exposure score and market preferences exposure score, to compute the transition exposure score. The potential climate exposure rating is the weighted average of the physical exposure score and the transition exposure score. That's where you see the X and Y. Those are the weightings that we apply when computing the potential climate exposure rating. How are these weightings determined? They're sector and location specific. Here it's important to remind that we use the TICS classification. That's a sector classification. TICS stands for the infrastructure company classification. That is reference that has been developed by EDHEC and nowadays is fully recognized as a reference for the infrastructure asset sector. Now, just one last mention on that very back slide, we can rescale the physical exposure score and physical and transition exposure score into a rating scale that ranges from A to J, which is the rating scale we use for our potential climate exposure rating, where A is low exposure and G is high exposure. Now that we have unpacked the methodology behind the potential climate exposure rating, let's move to the next slide, where we'll put the spotlight on the physical hazards model. Well, modeling physical hazards is based on a very transparent 6-step framework that I will present on that slide. So if you bear with me, let's follow the various steps. I have mentioned that we use satellite data and damage functions, and that is where I will deep dive into how we do that. We start with an asset-specific location that is collected on a map. Here we look at flood hazards. We then use this location to further refine it and produce what we call asset-level shapefiles. Those are very precise drawings of the asset boundaries of a given asset. Then as a third step, we will associate to that climate hazard maps. A climate hazard map assigns a number to each pixel, reflecting the expected flood depth in meters over a specific return period. As a fourth step, we will associate damage functions, which I mentioned several times already, which convert each pixel water depth into a damage value on a scale from 0 to 100%. And that depends on the asset type in that pixel. We use more than 30 different infrastructure-specific damage functions, and that adds further granularity and precision to our scoring approach. The fifth step is using asset value, the zonal statistics that I mentioned, and then the asset's boundaries to produce an average of all damage values within the precise asset boundaries that we score. Last but not least, step 6 is about adjustments. We use decarbonization and resilience measures implemented at the asset level to further refine our ratings and so revise the damage functions. And this is based on specific effectiveness factor that I will elaborate on over the next slides. Let's wrap up. While it varies significantly by industry and location, physical risks drives approximately 70% of the climate-related impact on infrastructure. That is why this very granular approach is extremely important. With that, let me show you why this approach is a game changer. If we move to the next slide. Thank you, Natalia. So precise spatial footprints are crucial for accurate risk assessment, especially for infrastructures. Infrastructure assets, they can span over very large areas that are uneven, like let's say airports, which is the example we look at. Typical market solutions will adopt what we call the generic buffer approach or the generic radius approach, which you see on the flood map on the left-hand side of this slide. What we use at Scientific Climate Ratings is the detailed asset boundaries approach that is on the left-hand side. We look here at London City Airport, and we can see that with the detailed asset boundaries approach, the physical damage at risk is at 14%, compared to only 1.15% for the physical damage at risk using the 500 meters generic radius approach. This example clearly demonstrates that the generic radius approach underestimates flood depth and damage by a factor of 10 compared to our method using the detailed asset boundaries. A quite striking example, I would say. If we move to the next slide, having established carbon emissions as a key input for our transition exposure scores, let's now dive into the model behind our carbon emission estimates. We'll start at the top of that slide. When carbon data is not reported, at Scientific Climate Ratings, we rely on 13 sector-specific carbon intensity models, which are further refined to account for country-specific variation. Those are the models that you see listed on that slide. These capture the systemic aspects of carbon emissions. Now, if we move down, we look at adjustments. So our estimated carbon intensities by revenue are further refined using statistical models that consider company-specific information. That could be the age since inception of the infrastructure asset, that could be its location, as well as other relevant factors. Now that we have covered the adjustments, we can move to overrides. And here, whenever reported data is available, we overwrite the estimates with the reported data. The reason why that is key is that allows us to continuously improve our model by integrating reported emissions. Now, last but not least, on that slide, I've mentioned previously carbon cost. Carbon cost is defined, it's a key input of our transition exposure score, and is defined as the product of the carbon tax and the intensities we use. Now, carbon tax, we use the trajectory under the continuity scenario that I mentioned, which is the most probable scenario under the current policies and pathways. And so this scenario projects the theoretical tax level as a proxy of evolving climate policies. And again, what that allows us to compute is both regulatory and voluntary shifts in market behavior. Let's sum up. The key takeaway here is that we have a very granular, robust approach based on 13 sector-specific and country-specific models. Now, with that, I think we can move to the next slide, where I wanted to unpack with you the data quality score. The data quality score is a standardized metric which serves us to evaluate the data completeness, the consistency, and the relevance. This score is aligned with the PCAF, the Partnership for Carbon Accounting Financials, and plays a pivotal role in the process of ensuring completeness and transparency. So if we look, you have understood that we use different data sources to develop our ratings. However, data could be a challenge, and occasionally there are data gaps, which means that we sometimes rely on models to estimate carbon emissions, as we said. And that illustrates how important this further transparency of the data quality score is. So for Scope 1 and 2 emissions, for example, publicly reported data will qualify for the best data quality score, which is at 1, the highest quality, whereas, for example, privately reported emissions will qualify for a score of 1.5, a little bit less high quality because of the privately reported nature of the data. I won't walk you through all the other examples. You have these slides, but basically we attribute data quality scores to all the various sources that we use in order to really maintain high transparency. Our data quality scores framework brings additional quality and accountability to every input that we use. Now that we have covered that, we can move to the next slide, where I wanted us to look together at the reliability of our carbon prediction models. There is a saying that all models are wrong, but some are useful, especially in a sector that is defined by data scarcity as the infrastructure sector. So if we look at what we have on this slide, on the left-hand side, we show a chart that is showing mean and dispersion, standard deviation, of the estimated versus reported emissions. We have estimated emissions in light blue and then reported emissions in gray. And we see the mean, which is the dark, the black line in the middle. We can see that for all the TIC sectors that we cover, the mean is very close. And so we have a very solid and robust prediction model. Now, on the right-hand side, we have the weighted linear regression of the model that really also shows a very high adjusted R-square. The model exhibits really strong linearity, confirming the accuracy and the reliability in our predictions across the various TIC sectors. Now that we have covered data quality, let's take a closer look at the company-specific adjustments that we apply. We can move to the next slide. Thank you, Natalia. So climate risk is not just about exposure to climate hazards. It also depends on asset-specific vulnerabilities, which can be mitigated through various adaptation and resilience measures. Our ratings are adjusted to reflect for that various company-specific adaptation and resilience measures. And for that, we leverage our ClimaTech database. ClimaTech database is powered by EDHEC Climate Institute. This is a repository that synthesizes over 240 sources, including academic papers, technical documentation, and various industry publications. This comprehensive approach results in assessing more than 1,800 technological applications across the various subsectors that we cover and measuring their effectiveness. You have understood our ratings adjustment process fully integrates and leverages this ClimaTech repository. That is what empowers stakeholders to make informed and actionable decisions. With that, let's look at a precise example on the next slide. Here we look at an Australian airport. At the upper part of the slide, we are showing the unadjusted physical exposure damages and scores. And then on the bottom of the slide, you see the adjusted physical exposure scores. Now, this Australian airport has put in place various adaptation and resilience strategies that allow to reduce its exposure to flood and storm. If we look at that, we see that for floods, they use elevation and flood barriers, and that by leveraging our ClimaTech database, which allows them to reduce their flood exposure from 1.85% to 0.11%. Similarly, for storm, they have put in place windbreaks and undergrounding, which allow them to reduce their exposure from 0.40% of storm damage, expected storm damage, to 0.14% of expected annual damage. Now, all that combined translates into an improved physical exposure rating, which goes from F, which is high exposure, to C, which is moderate to low exposure. A powerful demonstration of the importance of adaptation and resilience actions, and of how ClimaTech's repository and adjustment process can significantly enhance our risk assessments. Now that we have understood the importance of adjustment measures, let's move to the next slide. Here I wanted to pinpoint where physical climate risk is concentrated. On that chart at the bottom, you see the distribution of our physical exposure ratings across the entire more than 6,000 rated infrastructure assets universe. And on the top, you see all physical hazards combined, the distribution of all the physical hazards combined. Now, if we look at the most highly exposed infrastructure assets, those are the 12 plus 6, the 18% on the right-hand side here. By removing the highly exposed assets, we remove 48% of all physical hazards. And then if we look at the low exposure assets or the less exposed assets, those are the 17% of A and B rated assets, we see that they only account for 2% of all physical hazards. A clear indication of the fact that high-risk assets detection is the foundation of building a resilient and future-proof business or portfolio management strategy. Now that we have understood the potential climate exposure ratings, let's see where you can find these ratings. If we move to the next slide, I wanted to show you, and we can click play, I wanted to show you a live preview of our dynamic user-driven rating interface. If you type in scientificratings.com, you come on our welcome page where you can explore our rating coverage map by clicking on the blue square. Now we land on our coverage map where you can search for a precise asset. Let's say we want to look at London City Airport. We type in London City Airport. We have the PCER scoring pop-up. You can find information about the transition exposure rating drivers and the physical exposure rating drivers, as well as the final ratings. You can de-zoom and then zoom on the map to locate a precise asset of interest. Let's say that we want to zoom and find the specific asset in France. We zoom in and we select this blue dot in the Atlantic Ocean. Well, not in the ocean, obviously. That's the Compagnie Commerciale de Manutention Pétrolière. And we can look at the detailed potential climate exposure rating report on our website. You can find additional information about the benchmarking, meaning the positioning within the rated universe or within the peer group, they're 44th. You can find the chart that I presented that explains the methodology of the potential climate exposure rating. You can find a very granular benchmarking of each of the key drivers of the rating compared to the peer group or the universe, as well as very granular information on the physical exposure data and the transition exposure rating, as well as the underlying data. Last but not least, you can find information on what could lead to an improved rating, meaning that we leverage ClimaTech and we show various resilience and decarbonization measures and their technological details. Now that you know where you can find our potential climate exposure ratings, I will wrap up that session and hand over to Rémy to unpack the effective climate risk rating methodology with you.
Thank you very much, Maria. And Natalia, you can move to the next slide directly for the effective climate risk ratings. We begin by looking at the business model of the infrastructures, like whether it is regulated, merchant, or contracted. We also look closely at the debt waterfall, the cash flow of the infrastructure. We project this cash flow over time and discount them to determine the net asset value, or NAV, with specific time horizon in mind, 2035 and 2050, or the end of the project lifespan if it doesn't expand that far. This initial financial valuation without climate risk is the starting point of our analysis. Then we integrate climate risk data into this financial model and rerun the calculation. There are basically two main types of climate risk data. First of all, the very high-level macroeconomic data like GDP, inflation, interest rates, which are not directly related to climate, but which differ significantly from one climate scenario to another, and which are given by climate scenario providers like NGFS. And more precisely and more importantly, there are asset-specific, forward-looking climate risk data, such as the cost of carbon, depending on the scenario, of course, but also on the asset-specific emissions, and the expected damage of flood, storm, wildfires, or heat wave, which are based on asset type-specific damage function and location-specific satellite data and shapefile, as Maria has shown previously. This gives us, like, integrating this climate risk data into the financial valuation model gives us a new NAV integrating climate risk, and by comparing the NAV with and without climate risk, we can quantify the financial materiality of climate risk in concrete monetary terms. That being said, and Natalia, we can move on to the next slide. When it comes to climate risk, the outcome can be very drastically different depending on the scenario. For example, in a no transition scenario, transition risks are minimal, obviously, but physical risks are higher. On the other hand, a net zero scenario involves significant transition risk and hopefully lower physical risk. The difference can be huge. In a climate catastrophe scenario, for example, the global average cost of carbon might be around $40 per ton of CO2 equivalent, while in a net zero scenario, it could go up to nearly $1,000 by 2050. So this has obviously a profound impact on asset valuation. We are talking about two very different states of the world. So to account for this variability, we start by considering not only one, but all the major climate scenarios that you can see, that's the step one, and calculate the NAV for each one, scenario-dependent NAV in step two. Then we assign probabilities to these scenarios using the research of EDHEC climate finance professor Riccardo Rebonato. It's on step 3. And we weight the NAV accordingly. This gives us an expected change in NAV, step 4, which we then map to our rating scale to produce the effective climate risk ratings in the final step. This approach moves us from beyond simple stress testing to an expected value approach, which is, I think, truly a game changer in how we assess climate risk. So if you still want or need to do a stress testing exercise, then you can do it, and you will use any scenario-dependent NAV listed in step 2. But if you're aiming to assess the true expected impact of climate risk, then expected NAV or change in NAV from step 4 is the right metric to use. I hope you appreciate how truly unique this framework is. We have never been anything like this before, and that's precisely why we build it. Climate risk should not be just about what if, but about what's likely. Okay, so that's exactly what we do here. And then we can move to the next slide, Natalia, as I see that time flies. To highlight another game changer, I think, in climate risk assessment, here is a real-world example to illustrate the outcome of our methodology. Starting from an initial net asset value of 100%, we calculate the expected impact of multiple physical hazards like storm, flood, wildfire, and heat waves, leading to a potential loss of 31 points in this case. This is, by the way, an airport located in the east coast of Australia. In this specific location, there is no big risk of wildfire or heat wave. I know there are definitely some risk of wildfire in Australia in general. We can see that regularly in the news, but not in this specific location. So the issues are, because it's close to the sea, the issues are more about storms and flood. And you can see the impact on the NAV here. You'll notice that the direct carbon cost impact is shown as negligible, like close to 0%. And I know this might seem surprising for an airport, given all the bad press around airport and how polluting they are, and I can understand that. But we are measuring here the direct carbon cost for the airport itself, not for the plane flying in and out of the airport. Some airports are already close to net zero in their operation, especially recently upgraded like this one. So their scope 1 and 2 are minimal, and hence their exposure to direct carbon price is also minimal. Second, you might find also surprising that the change in revenue impact due to the change in consumer demand is slightly positive, plus 8 or 9% in this case. I know it's surprising, especially in a climate risk model, but that's because our expected NAV that you see here is scenario weighted. Okay, in this case, the no transition scenario is by far the most likely based on our assigned probabilities that I've shown previously. And in a world with no strong climate policy and a continued demand growth, aviation actually sees higher traffic volumes. There have never been more plane in the air than today. So under this scenario, that trends continue, which support revenue projection for airport. I know it's surprising, but remember, there have never been more plane in the air than today. So that's why, yes, we believe that change in revenue will lead to an increase in the NAV of airport in this case. But here it's where it gets interesting. By integrating resilience measure, Natalia, you can just click, such as in this case, long story short, they put some asset underground to lower the impact of storms. And on the contrary, they elevated some other assets with critical electronical components to lower the impact of flood. They also, more importantly, put some flood walls all around the airport to protect from the flood impact. And with that, the airport has almost cancelled out the impact of physical climate risk. NAV in the end doesn't just recover, it's rising up to 103%. That's a 25-point gain by 2035, directly linked to adaptation and resilience strategies. This is exactly why measuring exposure isn't enough, and we also need to value resilience, which is not just a cost, but a value creation lever. It's important for us to end on this point because putting a value on adaptation and resilience is what will ultimately help shift capital and investment toward a more resilient world, a more resilient future. So that's how we believe we can truly make an impact. We are not here to say that climate risk will destroy everything everywhere tomorrow. Climate risk is, of course, a global phenomenon with local impact, and we all know that. Some assets are far more exposed than others, and our ratings are designed to exactly identify them with the PCER and measure the expected financial impact with the ECRR. When adaptation and resilience strategies are in place, or plan to be in place, we quantify the financial value of these adaptation and resilience strategies with a forward-looking perspective. And I think that's very important if we do want to make an impact and drive investment toward a more resilient world. So with that, I end my presentation and give the floor back to you, Maria.
Thank you, everyone. Thank you, Rémy. Thank you for your attention. With that, we open our Q&A session. We wanted to remind where you can find us next. That's a timeline of our upcoming events. We'll be very happy to see you at the IPE webinar or in live in London, Rotterdam, or Paris, where we will be next. Please feel free to follow all events on our LinkedIn page or our website, scientificratings.com. You also have our contact details below. And with that, the Q&A session is now open. And thank you once again for your time.
Thank you, Maria and Rémy, for such a thought-provoking discussion. Now I'd like to get to our questions, and there are quite a few already. We will begin with those and then take a few from live chat as time allows. So let's start with the first one, which is, how do you assign probabilities to scenario?
Okay, so I'll take this one. It's a question that I get every time we made a presentation on this. So there's actually a 45-page long research paper dedicated entirely to this question. It's available on the EDHEC Climate Institute website, and it's called Assigning Probabilities to Climate Scenario. So you can find it easily. Long story short, Riccardo Rebonato, the EDHEC climate finance professor, demonstrate that although climate scenarios are inherently multidimensional, they can be reduced using a principal component analysis. Over, I think, 95% of their variation can be explained by just three factors: emissions, temperature, and GDP growth, basically. So the method focuses on forecasting emissions based on assumption on abatement policies and abatement speed. From there, emissions are linked to temperature using climate models and temperatures to GDP growth using specific damage function. Finally, the predicted or the projected trajectory are compared to the existing climate scenarios, and scenario probabilities are inferred based on how closely they align with the projected pathway.
Thank you, Rémy. That clarifies it nicely. Now let's move to another one. Will scientific climate ratings be supervised or regulated by ESMA?
I'm happy to take that one. Yes, we fully intend to register, to apply for registration under the upcoming ESMA regulation for ESG rating agencies. We have already taken some steps in that direction. We have notified our unsolicited rating issuers about the initiation of coverage with the potential climate exposure ratings. We offer them the opportunity to review their ratings and, of course, to correct any factual inaccuracies. We have a questionnaire that they can populate to further improve further the accuracy and lead to open up to adjustments. What else? At Scientific Climate Ratings, we really believe that transparency is non-negotiable, and we want to stand away from the black box effect. And to support this commitment, we really provide open access to our technical documentation on our website. Feel free to really connect to scientificratings.com and have a look at our methodology documents. And in addition to that, we also ensure, of course, full support for our rated issuers. So feel free to contact us anytime if you have any additional questions. I hope that answers the question.
Thank you. There are some more questions coming in. One of these, to what extent do you consider insurance coverage in the ECRR methodology?
I take this one. So I see that there are some insurers in the audience. That's cool. We have intentionally chosen not to include insurance coverage in our ECRR methodology. The main reason is time horizon. Like insurance contracts are typically short term, often renewed annually, while our ratings are forward-looking with two time horizons like 2035 and 2050. So relying on today's insurance coverage would give a false sense of long-term protection, especially as climate risk intensify. I think there was someone, a senior executive from Munich Re, saying that a world with a 3 degrees warming is not insurable. Yes, the cost of and the availability of insurance may shift dramatically and disappear altogether for certain regions and asset classes. So that's why we don't integrate them in the end.
Okay, thank you. There is another one. As you mentioned, there is a plan for expansion. And so when is the launch, is planned the launch of listed equities?
We do have a strong roadmap to execute ahead of us. Our initial focus has been on infrastructure ratings, and the PCER are already available. The ECRR will be released in Q4 this year, 2025. In parallel, we are finalizing the development of a data and analytics platform for clients who want to assess climate risk even before the asset is constructed or invested, in case where no rating can be issued, basically. So to come back to your question, on listed equities, we are targeting a mid-year launch next year. The methodology is already developed and ready, but what's taking time is that, we believe it's essential to take this time to do it properly, is the physical risk component, because obviously you can't seriously assess the physical risk of a global company by only looking at its headquarters. So we need to know exactly where the assets are. So we need to have the list of all the production and distribution sites everywhere in the world. So we are partnering to create this global data set of this location for all the largest listed equities in the world. We are already piloting this with a major food industry player, and they have alone not 1, not 10, not 100, but 1,900 production sites in the world. And that's only one example. So yes, it's taking time to build this database, but we believe it's essential. So long story short, mid-year next year.
Excellent. We're looking forward to it. Oh, this is a good one. Are all your ratings available for free of charge or not?
I'm happy to take that one. Well, as we have seen, all our potential climate exposure ratings are available on our interactive coverage map and on our website. Terms and conditions of use depend on your profile. So, for example, if you are what we call a pure asset owner, you can use these ratings free of charge. If you're an asset manager, those are subject to different permissioning terms, and we, the sales team, will be very happy to elaborate and to discuss that with you. So do not hesitate to get in touch. Now, Rémy mentioned the effective climate risk ratings already. These are primarily solicited ratings that are not yet available in the public domain, and that is because we have initiated the needed steps to notify the issuers. But those, as he mentioned, will be also available towards the last quarter of the year. And again, for more information, we are very happy to discuss your precise need and case. You have our contact details of the sales team on the last slide.
Okay, well, there are a lot of questions, and but unless you want to pick anything, I think we will have one final question before we will wrap this up. Let me see. Okay, so how do you determine the weighting factor of physical and transition exposure scores in your PCER? That's the question.
Happy to take that one as well. So maybe, Natalia, if we move on to the first chart where I was trying to unpack the potential climate exposure rating, I think it's slide 9. So the weighting factor is what what we call the XY percentage factors. So this is, as we said, sectors and location specific. And so basically we determine this factor based on the relative impact of each of the risks, so physical and transition risk, on net asset value. For that, we use we have based that on an empirical analysis of the ECRR rated universe. Maybe I can give you a more concrete example. So let's say you are a co-producer that carries a significant weight because of the regulatory burden related to co-usage. So for these players, the weight of transition risk will be much higher than physical risk. It's 2/3, 1/3 approximately. Whereas it's the opposite if you're a motorways player, the situation is reversed. You're much more exposed to physical risk than transition risk. So I hope that answers the question.
Sure, it was. Thank you. And I think there was a great round of questions. There are a lot we received, and however, it brings us to the end of the session today. If we didn't get to a question, please don't worry. We'll be happy to follow up directly after the webinar. And as a reminder, the recording of this session will be available upon request next week. And on behalf of the entire team, I'd like to thank you for joining us today. We hope you found this session useful, and we look forward to seeing you soon. Have a nice rest of your day. Thank you.
Thank you.
Thank you. Goodbye.